Hi.
Thank you.
Hi there. Yeah, that's absolutely fine. Well, good afternoon, everyone. I wanted to focus a bit more on some of the things that Angela raised. One in particular around the emerging challenge that we need to return to, which is around Brexit. So, starting with the governor, can you say to us where you think things are at in terms of the range of outcomes for the economy and how the forecasts would differ, including in the circumstances in which there's not a free trade agreement, and what that would mean. And if you could just talk us through what the worst case scenario would be, where if we had no deal and a second wave, what does that mean for the economy, and what interventions could the bank be making to try and reduce the even greater challenges on top of what we already have? You're on mute still.
Sorry, Andrew, you're on mute. Yeah.
Is that better?
Yes.
Fine, sorry about that. To mute while we were out. So I won't go back over what I said earlier, except to say that I think the key question, which you rightly point to in what you said, is it's not so much what trade agreement is reached, it's how much disruption goes with it. And obviously the weaker the trade agreement to no trade agreements, the question obviously is begged, does that lead to more disruption? And as I said, that's a question we will be coming back to in November, not least because one of the important questions for us, well, two important questions. One, has COVID had an effect, first effect, in the sense that surveys that we had last autumn on this question, I think suggested that about 60% of firms in this country felt they were reasonably well prepared. Question mark, what is COVID? What is the disruption caused by COVID done to that measure of preparedness, and then the scope for disruption? So that's one question we'll be coming back to. I think the second question here, and here it gets, I'm afraid, pretty complicated, of course, is, you rightly pose what if we have a big return of COVID, and we have some trade disruption at the same time. Now, the reason I say it gets complicated, here's the problem. Both of those things disrupt trade. And you can't disrupt trade twice, as it were. So unpicking those two is complicated. We started that, addressing that question sort of in the August report in thinking about the fan chart. And we have got, as I said earlier, a very big, downside skew on the fan chart. So you've got a lot of stuff that can unfortunately, go wrong in that space. I would say that based on the work we did in August, the downside risk, the short-term downside risk from COVID is much bigger. The disruption that COVID can cause to the economy is much bigger in the modelling we did in August. Longer term, of course, hugely dependent on, do we get, as I mentioned earlier, the sort of gradual amelioration of the sort of the impact of COVID without assuming any sort of vaccine breakthrough. You might think that the longer term, the relativity shift, that it takes longer for the economy to adjust to trade disruption through disruption around the trade agreements, and the COVID effect might come off a bit more quickly, but that's a judgment. The last part of your question, I was going to, you rightly asked the question, what will the Bank of England do? Well, I hope I can give you assurance on that front, both by what we did in March and by what I said on Friday in the virtual Jackson Hole session, where I made the point that it's very important that our policy framework is robust enough so that we can act, as I said, we can go big and go fast if we need to. Because obviously, if we see the sort of conditions that you were talking about, then you would expect, and we would expect, frankly, a sizable reaction from the banking and the monetary policy.
So, Governor, could you just elaborate on what that might look like? And also, I appreciate what you're saying about. Well, I appreciate what you're saying about COVID risks being greater in the short term, but you haven't. I want to push you a bit further to give us a sense, because the public will be looking at this and wanting to get a sense of what that combined threat looks like for us as a nation, and what government needs to do, as well as what you will do in the bank and others will do.
Well, okay, so the fan chart in August has, as I said, I mean, broadly, we had three international issues in mind. One was obviously COVID, both domestically and internationally. Second was the question of, how's the trade agreement with the EU going to come out? The third one is the one we haven't mentioned yet, which is broader, what I might call geopolitical tension, US, China, whatever. All those three things are out there. Now, I should say, when we draw up fan charts, we don't precisely calibrate these things. That's a hazardous business. But again, the fact that we've got a fan chart, which I think I'm right in saying, if you measure it at certain points, I mean, the edge of the fan chart has a GDP level which is somewhere like 12 to 14% lower than what it is at the moment. Will give you a sense of the scale of the things that can go on in that. The interactions are very complicated because, as I say, all of those things could lead to a reduction in trade. And that is, we're going to do more work on that, and we're going to do more work on the state of preparedness. Hopefully, we can get a better read on that as the economy comes out of the COVID shock in the next.
Okay, so just a final question for you. Okay. So just a final question on you, just picking up the point about big and fast. If we say we end up with the worst case scenario and a doomsday scenario, and of course none of us want that, what does big and fast look like through the lens of your role in the Bank of England?
Yeah, of course. So, I mean, look, can I make 3 points about our toolkit? We've done a lot of work on the toolkit. That part of that work was summarised in the Jackson Hole speech I made, and actually in the very big paper that we issued on Friday. So first of all, I did make the point that there's a lot of debate about how quantitative easing actually works. I mean, Ben Bernanke famously said it works in practice but not in theory. We advanced with some caution the argument in that paper based on evidence that particularly in situations of market dislocation, and that may well have sort of economic dislocation behind it that we had in March and that you're talking about in what may come, it seems to have a bigger effect. So it's a tool that is somewhat state contingent. So that's an important lesson to draw about how we use that toolkit. As I said earlier on, we've also pivoted to use forward guidance. And thirdly, we've made quite clear that we've done work on negative rates actually since the last Treasury Select Committee hearing we had, where I set out what we would do. We think that it is a tool that it's in the box of tools. We're not planning it at the moment. We've got no plan to use it imminently, but it is in the box. If it was the right thing to do in response to the situation you've just described, if it was a better approach than the other tools, then it would, the case of bringing it out of the box would be strong.
Right. So that's really helpful. Thank you. Would anyone else like to come in on any of those points from the panel?
I mean, that sort of goes back to hearings we had in that prehistoric age before COVID. I remember you talked to Mark Carney about this, and you talked to me about it, I think, at my appointment hearing. And I think both Mark and I were talking about sort of how we calibrated headroom in monetary policy at that time. I made the point in the Jackson Hole remarks quite good. We've done a load of work and obviously, been through a very big situation. And frankly, I think, looking back, as I said in the Jackson Hole remarks, hindsight is a brilliant thing when you have it. We probably underestimated the headroom we've got, that we now think we've got, because we've done a huge amount of work to think our way through a problem.
Right, thank you. So Dave, you had your hand up.
Yeah, thanks. Just to really reinforce what Andrew was just saying, in terms of the disruption that might come with a disorderly WTO or other deal, so where there was disruption at the ports and such, there's obviously a limit to what we can do by going big and fast But if there was any sign that a combination of COVID and whatever happens on Brexit, or indeed any other shocks, and Andrew alluded to geopolitical shocks, but then, and also other shocks can always come along. I think what we've been trying to stress in recent weeks, I did an interview for the Times back in August, Andrew did his speech last Friday, is that we can step up the pace of QE significantly. You know, we've slowed the pace to 4.5 billion or so a week. Back in March, when we were going big and fast, we were doing 13 billion of purchases a week, by far the fastest ever. And that had the effect of dealing with the financial market disruption, which otherwise could have had an impact on the real economy and affected lending. So I just wanted to reinforce that short-term point. And then on the long term, as Andrew was suggesting, Brexit, the deal that we get will come more to the fore in terms of its long-term impact. All the analysis that the Treasury, that the Government Economic Service has done for the government, the independents of analysts have done, suggests that the impact of changes in trading relationships really come through in the long term. You know, they build up incrementally, and that's where, for example, you would see more significant differences between a free trade agreement of the kind that we've assumed in our central case, but also if we fell back on orderly WTO terms, what that might mean. Those would have much longer term impacts, but equally they might also be offset by a repositioning of our trading arrangements, because obviously you have to take account of new trade deals that could be done through us not being part of the EU.
Sorry, Rushanara, you're muted, I think.
Sorry, it happened automatically. Just to wrap up this. Yeah. Okay, just so you could envisage a situation in a worst case scenario with a second wave and no deal Brexit, that QE could be significantly higher than what has gone on before per week.
Certainly high. In August, let me just give you the timeline. Back in March, we were doing 13.5 billion of purchases, 13 billion or so a week. We slowed that to just under 7 billion back in June, July, and then we slowed it again to 4.5 billion in August. We both have in order, as Andrew was saying earlier, to complete the current programme by the end of the year. We have headroom to do materially more QE if we need to add to it, and also we have the operational and other capabilities to do it fast if market dysfunction required that. So we can influence both the size and the pace.
Thank you very much.